Hello and welcome to the Harwood Report for March 5th, 2019. I am Keith Harwood, the founder of Trade Academy and the author of the Harwood Report. Before we get started, let's do the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of these disclosures and then we will get to the charts and a little bit of commentary on them. Alrighty, let's discuss what we're going to be looking at today. I really want to focus a little bit on equities. We had the big break in gold last week finally, so that played out. It took a little longer than expected, but now we got that move, and I'll talk about where I see that going next. Oil consolidating. Let's talk about what the trigger points are there and where the opportunities are. But first, as always, I start with fear and greed, and at 67, it's a little frothy, but not crazy. It can hang out up here. It doesn't have to collapse, obviously, to the point where we get fear again. We may just get little, blips here. That can happen either via consolidation or slowing of the uptrend. Where are our greed metrics coming out? They're calling this extreme greed. Hanging out here, we'll switch this from extreme greed back to greed or even neutral because relatively where we are from where we were about, 9 months ago, it's about the same. This was obviously extreme fear. Now I'd say we're greed, maybe extreme greed. We're definitely at some greed here on stock price breadth. Every stock is rallying. As we rotate into a stock picker's market, that shifts from extreme greed back to greed. This, to me, is relatively neutral. Again, we saw significantly lower levels in May, June, July last year, where there was a lot less interest in puts and more trading in calls. And that was a bigger signal of extreme greed, and it didn't mean anything until about October. So frankly, this is not a signal that the market has to pull back. This means nothing. This is neutral. I'm happy with that. This means nothing. And again, I actually think that this is closer to neutral. So I think a lot of these signals are being, sort of overstated in order to try to promote some conversation. But generally speaking, I think that this is fair. 65-ish is about right. We can get to 80, 85 before I get nervous on this metric. I also look at a couple of other metrics, and you can see some of them in the chart here. The RSI has, the MACD has rolled over a little bit here, showing a lack of momentum. That's not a bad thing for the market. It's just allowing things like this 50-day moving average to catch up, and the 100-day moving average to switch to an upward slope, and the 200-day moving average to switch to an upward slope. So as we see things like the 50-day moving average in particular start to catch up, that can help give people a little bit more confidence because they have a closer stop. So people like to use the 10-day moving average, which is right here, the 20-day moving average, the 50-day moving average, the 100-day moving average, and the 200-day moving average as relatively frequently used stops for the market or entries on the short side. Right now, we're holding above all of them. Everything still looks good, but what we're doing is consolidating again. So we consolidated for a few days here and had a little breakout. Then we got a little bit more bump, a pullback. This is just a little bull pennant here, bull flag type setup. A pop, a little pullback, and then you get a pop, a little pullback. So I think that right now what we're doing, and I've been kind of talking about this for a little bit now, is that we get these pops and pulls, and they're getting smaller and smaller. Kind of reminds us of what we saw here, but these things can last for a long time. They can last for months. Maybe we're getting to that point where the market is getting close to fully valued, which is probably where we were in September with 292. But if we get a fundamental update like bullish trade war negotiation stuff, none of this has to necessarily hold. We could see 300. As this process winds through, what I'm looking for is this to get really low. So when the VIX gets down here into these low levels, 11, 10, maybe even single digits like we saw last January, that generates this explosive return profile where if that gets really cheap and then we get a fundamental update on China, we can get a massive move with cheap options. That's what I'm looking for. I'm looking for those setups. Now, where I find them tends to be right now in individual names because we're in a market rotation element, but I think there are some plays out there in just playing for small bounces and things like that, more off of things like butterflies. I talk about that more in the premium newsletter, and if you want to see that, you can sign up for a free week trial. It's worth your while. And I go through all this stuff with the actual trade ideas that I'm looking at. Now, when I go to the Qs, it's similar, but actually a little bit stronger now. So we're seeing that relative strength, right? The SPY was hitting at the 10-day moving average. The Qs are showing a little bit of relative strength. During the downtrend, they were showing relative weakness. So you see how this had a downslope on the new highs, or the bounces were lower highs. On SPY, those bounces were basically at the same level. And we're at that level now. But the Qs are showing us some relative strength, and where we're really seeing that relative strength is in the semiconductors. So semiconductors have basically unwound the entire break after having a really, really bad October, November, and a terrible December. Okay, so now that SMH, the semiconductors, which is supposed to be a bellwether for stocks, have completely unwound this, that's got to give some confidence to the investment community again. The thing that I've been keyed in with in the small caps is the fact that they have underperformed. They're still now back below the 200-day moving average, but there's got to be a catch-up there, especially if TLT is weak, because that puts a bid to financials generally. And financials are a big component of the small caps. I think where you're getting a little bit of this slowdown, we'll call it in IWM, is the fact that it had recovered so much from its lows when it was leading the break. So now it needs to kind of take a little breath before it gets that next run higher, potentially back up here into the 170s in the next, say, month or so. There's a lot of leverage potential there, but right now, this week, I don't see this being the one. If a China trade deal comes through, I think that's probably just better played out of SPY and the Qs because the China story is kind of tech-centered, right? We go to TLT. The bond market really got hit the last 3 days. I think that as we start to see that people are getting more confidence in the stock market and confidence in the trade deal and everything else, that the assumption is that, okay, fine, maybe we can actually go back into a rate hike environment, or at least we're probably not going to lower rates. So there was a little bit of fear that we might even have to lower rates, that the Fed might have to take some action here. As the confidence that things get dealt with China and that the macro economy is improving, we get back into more of a stasis environment where we could see a move back down here to 116.5, sort of down near these lows. I don't see us getting down to 112.5. Volatility is getting cheap in the bond space, so there's some plays here. But right now, I think we have to probably do a little bit of chop here, maybe like we did here. The 200-day moving average is a level that we like to chop for at least a week before we get the next move. So let's probably expect to sit for a week, and then maybe the play comes next. Of course, I said gold. So this one's a big one. Gold had the big break on Friday. Okay, and now it's continuing lower. It is trading in this range, much like we saw in TLT, where it's trading around that range. But, this is nowhere near the 200-day moving average or the 100-day moving average or the 50-day moving average. It's kind of out in the middle of space other than this little consolidation area. I had been targeting this move down to about 121. We're basically there. I kind of think that we could have a little bit more fall, but it may not get so aggressive. So it's a slower move, more of like a put spread type play for the meanwhile. And with dollar yen firming, that could accelerate it. So if dollar yen can get back up here towards 113, that could accelerate the gold break, and then that becomes an outright put play. The one that really got hit on Friday actually was silver. Leverage was cheap there. It's still cheap there. It's down to the 200-day moving average. But our real support level to me here is down towards 1360, 1365. So we've got some really cheap 14 puts out there that make that play. So this has actually got an interesting leverage situation because it's been relatively weak to the other precious metals, gold, platinum, palladium. So as we see this weakness in silver and cheap leverage, I think there actually is probably a better play here in outright puts than put spreads. And I talk about that more again in the newsletter. Finally, let's go to oil. USO on its own is consolidating. There is no real major story here. We're sitting on the 10-day moving average, allowing some of this stuff to just kind of converge, consolidate, and hit the oil VIX. Let me see if I can find that symbol for oil VIX on here. No, I can't right now. I can't remember what it was. I think it was OVX. Yes, OVX. Okay. So you see oil VIX is coming back down to reasonable levels. It's a little harder to see because these weird spikes that come into their metrics, but we're getting down towards the recent lows. Last year's lows were, 23. So 29-30 range is getting pretty cheap. Leverage is starting to get there. When that coil breaks, I get a little more excited. And I'm looking for it in XLE. So if USO, we'll go back to that chart, gets above the recent high here at 11.99, if I recall correctly. And 12.06 on that day. We got to 12.06. 11.99 was the high on on one of these previous days. Anyway, if we get above 1206, we get that breakout in oil. I think that puts money flow into the oil equities, and XLE has great upside into the 74-75 range. Similarly speaking, OIH has great upside into the 21-22 range. This is where the real leverage is. This guy can get really cheap volatility from this long period of consolidation. So I'm really keyed in on watching oil, looking for that to break out, and then getting some cheap calls for a squeeze type play in OIH. I think it can get exciting there. All right, guys, that's my key focus now. That we got our breaking gold, I'm watching the oil stuff. That's going to take a little bit of time, but I want to watch it closely. If you guys want that premium newsletter I talked about, it's an amazing deal at $49 a month, and I'm going to give you guys a week for free. So go to tradeacademy.co/Harwood Report to sign up. Get your week for free. Then after that, it's only $49 a month. I give you the Monday newsletter where I talk through the trade setups that I'm looking at on Mondays, and I get you a midweek video update as well. That's for premium subscribers only. Call me, 312-600-8004, or if you really want to get a hold of me, the easiest is email here, keith@tradeacademy.co. Thanks again, folks, for watching, and I look forward to seeing you all on the premium product later this afternoon. Have a great trading day.